in that with me. So just a few comments for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risks and uncertainties, some of which are significant in scope and by their very nature beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results in future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. So I'll, just as a quick note of background for those of you who've joined who may be less familiar with me, my name is Bill Woodruff. I founded WealthFactor in 2017 and am responsible for all investment activity at WealthFactor. I've been investing for over 20 years now, and have a diverse background, mostly building and managing portfolios for other investment professionals. WealthFactor is a Lake Oswego-based investment advisor. What we do is build custom investment plans for each of our clients and offer that through an investment advice service. We build portfolios that are customized per client, but generally based on indices and mostly comprised of stocks and or bonds. Accounts are held in clients' names at independent third-party custodians. And we charge a 0.35% fee on assets up to 10 million, and then 0.1% on assets over 10 million. Just a quick note about the composition philosophically for how I approach investing and building portfolios. The philosophy is called Risk Smart, and there are three core components to that. Being portfolio smart, which is a reference to the structure and largely about what investors should avoid. It's my belief they should generally avoid things like attempting to pick securities and time markets. They should avoid layers and they should avoid complexity. Fee smart, it's my belief that high fees forces investment advisors to take on unnecessary risks in portfolios. And the last element in risk smart is being tax smart. This is something that I see that's often overlooked, but at the end of the day, after tax results are really what matters most. So as I dive into and talk about the prior month, it's important to contrast my intention for this monthly update to what you might stereotypically expect from a call like this. I won't be spending a lot of time on specific details in these sorts of calls. I philosophically believe that those that get really focused on what's going on in the short run are put themselves into positions where they're likely to make structural or investment-oriented mistakes that will inhibit them from capturing the returns that markets can provide. So I'll start out, I'm going to provide just an overview of April's update. So this is actually a slide used last month, but it's really still relevant in terms of the elements. And so there has been really since the bottoming out for risk assets, including equity prices in March, with the idea that this doesn't make sense. There's going to be a recession, earnings are going to go down, why are prices going up? And so in April's update, we covered a variety of those elements. Many of these elements are still true. I think it's important to always remember that the stock market doesn't represent what might happen in the next day or two. Current pricing really represents the market's attempt to value companies, and it does a nice job thinking about that out, typically somewhere between, let's say, 6 months and 3 years. And that's the challenging part in terms of for those that think that they might be able to try to time markets, is you really never know, what that time frame is. The thing that I believe, and I think why there's an opportunity for those that have take a disciplined approach to investing is, I think while the market has the potential to do a nice job of factoring in what might be happening over the next 3 years, that's really the extent of the average investor's time horizon. And I believe that stocks and other risk assets should be looked at with an investor's lens and more like a 10-year or longer time horizon. And I think that there's going to persistently be opportunity to generate return. Perhaps there's a little bit of U.S.-based optimism in how I think about the world, and maybe humanity a little bit too, in terms of continued. Will we continue to innovate? Will there be businesses? Will businesses continue to exist, and will they continue to provide goods and services to individuals and other companies? And I have that optimism, and I think as long as that holds true, we will continue to see riskier investments, or maybe more specifically, diversified portfolios of equities outperform safer and perhaps less stable investment choices like cash and higher quality fixed income. So today I'm going to cover, today I'm going to try to keep it pretty brief. A lot of the themes that happened during the month, that if we try to ignore the detail and the noise, thematically, again, there's a lot of overlap to April. And so I'm going to spend a little time talking about the longer term context, which I think makes it easier to appreciate why we've seen equity prices go up so dramatically. I like to look at and stay aware of the divergences that you see in performance from a size and style perspective. I've done a fair amount of research on the topic, and believe that it's easy for investors to get overly focused on what did well yesterday or the last couple of years. But that the time and energy I've spent on that topic would suggest that over longer term cycles, the next 10 years might be a very different group of stocks that provide strong returns versus the last 10 years. And then I'll spend some time talking about interest rates and fixed income. And I think that's an important element, because whether your portfolio includes fixed income or not, depending on whether that makes sense from a stage or risk profile perspective, I think as I build portfolios, it's always a process of trying to think through the relative risks versus the return opportunity. And fixed income right now, in any reasonable amount of quality, and then even to some degree lower quality fixed income, yields have really gone very, very low, and that's a supportive element for higher valuations for equities and higher prices for equities, as investors have dollars and they have to go somewhere. And cash is clearly a choice, but with the Fed and interest rates at zero, cash probably continues to be a choice that could be, relative to other things over a reasonable period of time, a pretty painful place to be. There's a few graphs that, if you participate in my presentations like this, you'll see frequently. And so, what this graph is it goes back to the 1900s and looks at U.S. equities prices. And so, it puts and it's in a log scale, which allows the visual change in the early part of the graph to appear, at least from a scale perspective, similar to today. If you didn't do this, if you didn't put it in a log format, it would look like an incredible hockey stick where it's flat and then it just ramps up dramatically. So log scale is really the only way to look at data going this far back. So, the point here is that it's so easy to get focused on what's happening today and what's happening this year, last year. But if we look at this downward movement in prices that we saw in the first quarter, you could draw both sides of the conclusion that one, it wasn't nearly as bad as it perhaps could have been. But I think the better conclusion is, these sorts of things are just part of markets. And what we really need to do is work very hard on not allowing these things to affect how we invest, and stay disciplined to really a target set of exposures or some sort of investment plan. As I as I think about the process I went through so far this year, I had a lot of newer clients over the prior, let's call it 9 months, who the potential reward relative to risks didn't feel great. And so oftentimes what I was doing was creating investment plans where if markets declined, then buys occurred. And a lot of the fixed income exposures that I had built for clients were very tilted towards treasuries or the highest quality fixed income, with the hope that at some point the compensation for taking more credit risk would emerge. And a lot of that played out in the first quarter. And so then let me share a quick graph here. So this graph is the S&P 500 over the last 12 months. And so, just to put a little bit of perspective on the, very fast decline, not unlike, say, the severity, although the duration's longer than a 1987 sort of decline. And, we really are seeing a V-shaped price recovery as you look at it over this sort of time frame. And so, this sort of thing, as, I perhaps try to deal with the practical challenges of putting investor dollars to work and wanting to balance risk and reward. As prices decline and compensation for risk looked a lot better, there was a lot of activity in terms of investing more into stocks in the first quarter, and then taking on additional credit risk. And at that time, those decisions weren't based on the idea or some sort of forecasting or belief that there would be a V-shaped recovery. It's as I approach this, it's always, I don't know what's going to happen in the short run, but these are, I'm now being compensated for my risks relative to each client's specific capabilities and to endure that risk. And so what's largely happened for, as I navigate this is as prices recover across all sorts of risk types, both equities as well as bonds of lesser quality, and I'll say it that way because it's absolutely a spectrum from, let's say, an Apple bond to some sort of junk rated bond. As all of those have recovered in price, just like stocks, I've been proactively reducing and scaling those sorts of risks back that were added in the first quarter. So, my philosophical preference isn't to be active, but at the same time, I think it's not hard to conclude that a 40% decline, 40 to in some cases 80% declines in assets is probably irrational. And to the extent that you hadn't been exposed to certain risks in advance of those price declines, now might have been a pretty good time to take those on. I think that's the hard part for investing is the timing, and doing that is the point in which you're going to feel about as uncomfortable as you'll ever feel as an investor. So, I think that, as I advocate for having a advisor who can maintain a lack of emotion through the process, I think that's where, hopefully I can add a little bit of value for clients. Okay, so back to the slides here. Okay, so real quickly, talking about that divergence of style and size. And so, what at these measurements, there's no perfect science behind it, but size of company, and then growth companies, those companies that might not have the same sort of valuations, or it might be growing revenue really fast, versus a value company where there might be really attractive valuations, but perhaps aren't growing as fast or at all. One thing I'll highlight in here before I talk about the divergence in performance between style and size is that in this page versus the last month's set of data, what you'll see is the valuations don't look very good. And that's a function of market prices rebounding dramatically and earnings going down because of the restrictions for economic activity. So, I'll go back to my prior point, is in that prices are going up based on an optimism that the earnings over the next, let's say, 3 years won't be as dramatically impacted as people might have thought 45 days ago. Yet the PE as a measure of valuation is looking at what the earnings are right now. So we see price going up based on optimism that earnings over the next 3 years will be okay or better than feared 45 days ago. Yet the earnings part of it is clearly impacted because of all of the restrictions in operating businesses, providing services and providing goods. And so then looking at some of the dispersions, there's been a decade-long outperformance by large and growth, and we continue to see that relative to value and relative to smaller companies so strongly that large growth is actually up on a year-to-date basis. If we look at it on a quarter-to-date basis, those sorts of things are still persisting. I did see in the last week or two, which anytime I bring up anything from a reference perspective, it's not to suggest that there's a trend or one can predict these sorts of things. But in the last week or two, we did see a meaningful reversion in some of these environments where small value did really quite well relative to specifically mega large growth with a tech orientation to that. So I think there's just at some point valuations do matter, and so that will matter over time. The thing why valuations aren't the end all be all is we can't predict what the earnings of any one specific company, industry, or sector is going to be, and so it's entirely possible that mega cap tech just continues to grow its earnings at a far faster pace and revenue at a far faster pace than everything else, and its performance is the best. So that's likely the case for diversification. So I'll transition now to some thoughts on fixed income in general. So fixed income, for a moment, I thought was going to get easier, but what ended up happening is, as the opportunity in credit markets opened up, because of falling prices, we've seen an incredible snapback in those prices. And that's in two different areas: investment grade credit, where the government came in and said we're going to support this market, and so there was a near full snapback in price, and then even non-investment grade companies, or I'll use the word credit, sorry for the vernacular. I can't shake my roots with that one. So the non-investment grade or lesser quality bonds have appreciated dramatically from their lows, just like stocks, and perhaps still, for those that have the tax profile and risk profile and really need income, they probably still look reasonably interesting, especially relative to where they were at the beginning of the year. But for me, it's that's a bit of a stretch given what we've seen is an incredible decrease in yields and compensation for what I think is going to be, on a going forward basis, a really significant amount of risk in the short run and potential for defaults in those sorts of companies. So this graph here is the yield curve for U.S. Treasuries, and the dotted line is looking back to December, end of year 2013. And so what you can see, and at that time, coming out of the financial crisis, we the Fed was being very accommodative for its rates, but the market rates for really in anticipation of what ended up being a period of strong economic growth and activity, the market there was a steepness to that yield curve, where as you went out and owned higher, longer maturity bonds, you got quite a bit more yield. Well, in today's environment, the Fed is right back to that accommodative state where the very short end, 3 months is that starting point on the graph, is near zero yield. What we've seen is an incredible flattening. And as of the end of May, the 30-year Treasury had a yield of only 1.4%, and making for a very difficult environment for safe fixed income or safe investing in general, and that's by design. Now's the Fed wants to force, or at least at a minimum incentivize, investors in aggregate to go out and take risk and create economic activity. The fixed income is, as I alluded to, is far more than just the treasuries, and so here's some data points here for the end of the quarter and end of May. So corporates in general. So the challenge in using just a single data point for corporate is this is showing an average maturity of 12 years. Well, this index likely encompasses bonds with 1 year maturity out to far farther than 12 years. But it gives us a data point and shows us that yields, while Treasury yields, and let's use the 10-year as a relatively close comparative, while Treasury yields over the quarter haven't necessarily gone in any material way, we've seen corporates fall dramatically. And so what that effectively says is these aren't as risky as people felt at that time, and they're not requiring as much yield to invest in them. If we look at that, the spread or the difference between corporates and treasuries, it's still fairly wide, or investors are still getting a fair amount of compensation for that credit risk, at least relative to what we saw at the beginning of this year, but far less than at the end of the prior quarter, the first quarter of the year. And so as a reminder, as yields fall, bond prices go up. And so investments in corporates at the end of March, we've seen an incredible increase in price. And consistent with my earlier comments, in many cases where risk was scaled up in the first quarter, and in some of our most conservative portfolios, what that meant was a shift from treasuries to investment grade corporates. A lot of the investment grade corporate positions, or some of it, has been removed out of portfolios because of how fast that reversion occurred, a V-shaped price recovery. So that concludes my prepared comments for today.